Whether you've profited over the past 5 years or not is irrelevant. On September 16th of this year, we will all find ourselves standing at a relatively equal crossroads, from a seasoned investor like Warren Buffett to an everyday worker. Everyone will be forced to make a new, critical choice about where to put their money. If the Federal Reserve announces an interest rate cut on that day, it won't just signal a simple shift from high to low rates. More importantly, it is poised to completely reverse the investment logic that has dominated recent years. The assets that have seen the most growth will likely give way to assets that many people once dismissed. An asset you might have considered expensive at $100,000 could have already jumped to $200,000 in the last month alone. A year from now, you might see that same asset offered for $5 million and consider it a bargain, because its potential value could extend to $10 million, or perhaps even $100 million. So, what does this all mean? My message has always been that the Federal Reserve's decisions on interest rates are not primarily driven by inflation or unemployment, but by a much more fundamental factor: its ability to sell us treasury bonds. We saw this play out last year when even a slight easing of rates led to reluctance in the market to lend to the US. The dollar weakened. Bond sales stalled, and the Fed quickly abandoned any further rate cuts. At the time, some dismissed this perspective as a conspiracy theory, preferring to trust official narratives. The publicly stated reason for holding off on rate cuts was that inflation remained too high, with a target of 2%. Yet, even with inflation at 2.7%, a figure that doesn't fully capture the price increases consumers see at the supermarket, and with new tariffs adding pressure, the Fed's rhetoric has suddenly shifted. The chairman recently acknowledged that despite deportations of illegal immigrants, unemployment claims have not decreased. This has led to the official suggestion that a rate cut might be necessary, even with elevated inflation. This raises several critical questions. Does this mean the Fed has accepted the consequences of a rate cut, including resurgent inflation? After reports that non-farm payroll data was flawed, is this a tacit admission that the unemployment situation is so severe that they have no other choice? Does it signal an acknowledgement that the era of stagflation, a painful combination of high unemployment, stagnant demand, and rising prices, is upon us? Most importantly, has the Federal Reserve devised a new strategy to prevent a collapse in the dollar and treasury bonds following a rate cut, or has it simply resigned itself to this outcome? You may have noticed that while the dollar has been weakening against most global currencies this year, it has paradoxically been appreciating against the Chinese renminbi, RMB. And at the mere suggestion of a US rate cut, assets in mainland China and Hong Kong have skyrocketed. Why is this happening? After September, every moment your money remains idle, it risks being silently eroded by global inflation. Yet if you spend it, that capital is gone, and earning it back will be incredibly difficult. If you want to navigate this game and potentially improve your financial standing, I encourage you to subscribe for more information. If you're concerned you might forget these details, liking this video will save it to your playlist for future reference. The echo of 1972. Imagine you could travel back to 1972, armed with the knowledge of which assets were about to experience explosive growth. Could you simply purchase them and change your destiny? That's unlikely. We can't alter history. But what if I told you that the conditions we are witnessing today are not just similar to 1972, but are nearly identical? If so, the opportunity to position yourself for a significant wealth transfer could be right in front of you. In 1972, a Republican-led government was pressuring the Federal Reserve to cut interest rates and increase the money supply, just as we see today. High-level diplomatic overtures were being made to China, mirroring recent events. But the crucial parallel is what happened next. The Federal Reserve cut rates, flooding the market with liquidity. The consequences were severe. The US dollar plummeted 18% in a single year, inflation soared to 12.3%, and unemployment climbed to 9%. The US stock market saw a brief rally before falling 44% over 2 years. That was stagflation. Today, the Federal Reserve appears to be yielding to similar pressures. It seems prepared to tolerate soaring inflation and a weakening dollar. Likely because the underlying unemployment situation is far worse than official data suggests. It's reasonable to infer that a rate cut in September could produce an outcome similar to the stagflation of 1972. Another pivotal event of that era was the decoupling of the US dollar from gold. Today, are we not witnessing a gradual decoupling of the dollar from treasury bonds and its repegging to stablecoins? The Fed itself has admitted it is no longer basing its decisions solely on inflation data, but on a more flexible judgment of the economy. In essence, there is no longer a clear official standard. The mechanics of a global shearing, so what is the underlying mechanism at play? The strategy has historically been straightforward. The US lowers interest rates to near zero, encouraging countries and corporations worldwide to borrow heavily in US dollars. However, once these entities are heavily indebted, the trap is sprung. For example, imagine in 2020 I borrowed $1 billion to build several houses in Europe. With near zero interest rates, my annual payments were manageable. But in 2022, the US aggressively raised rates to 5%. and the dollar appreciated by 20%. When my loan matured, I faced a triple threat. I had to repay the principal and interest, but the dollar's appreciation meant I needed an additional $200 million in euros just to cover the exchange rate loss. With the houses still incomplete and generating no revenue, repayment became impossible. This leaves two choices: sell my assets to American capitalists at fire sale prices or default, and have my collateral seized. American capital extends cheap credit, then tightens monetary policy to strengthen the dollar, creating a debt crisis that forces the sale of valuable assets at a discount. Even if a company has the local currency to repay, its home country may lack the foreign exchange reserves, the US dollars, to facilitate the transaction. When a country's reserves are depleted, American speculators can short its currency, driving its value down further and making its debts even more expensive. This isn't just a hypothetical. Eventually, a full-blown financial crisis forces the country to open its markets. We saw this in 1997, when financier George Soros was accused of driving the Thai baht down 50%, forcing the sale of Thai banks and ports. Argentina in 2008 and Turkey in 2018 faced similar fates. The sheep are sheared, and in time, the fleece grows back. However, this time, the cycle has been disrupted. Despite the US hiking rates since 2022, very few countries have collapsed. Why? According to US think tanks, a new major creditor has emerged: China. During the period of US rate hikes, China began lending US dollars to developing nations on the brink of default. These loans carried an average interest rate of 4.2%, with a 10-year term a lower rate than the 5% the US government itself was paying on its debt. The key was not just the rate, but the flexible repayment terms. Borrowers could pay in US dollars, RMB, or even in kind with natural resources. This provided a crucial lifeline. China gets these dollars from its massive trade surplus with the US. By lending them out, it diversifies its holdings away from US debt, which it fears could be frozen, as Russia's were. Now, I'm not particularly interested in politics or diplomacy, unless it directly affects my financial outlook. But it's clear that as long as China can continue this cycle, the traditional American fleecing strategy becomes far less effective. This disruption helps explain why the US dollar has faltered while global stocks even in Hong Kong and mainland China have surged. It suggests American capitalists, unable to trigger widespread defaults, have begun buying up discounted global assets. September rate cut could mean they are ready to inflate the value of their new holdings,
once again,
rewarding investors and punishing savers. The United States has maintained high interest rates for almost 3 years, supporting global capitalists like Warren Buffett, who sold stocks to earn interest from the government. But with few countries collapsing, the shearing has entered its second half with a new primary target: China. The first step is to cut off China's supply of US dollars. The dollar has already appreciated 16% against the RMB. It's driven by a narrative of China's economic weakness and a significant interest rate differential. This has prompted massive capital outflows, with one professor estimating that $3 trillion has already left the country. While a weaker RMB might help Chinese exports, it makes imports of essential goods like oil and microchips more expensive, straining China's cash reserves. The next move is the imposition of tariffs. If China's dollar earnings cannot be stopped by monetary policy, they can be choked off directly. The US can levy a 50% tariff on Chinese goods and extend it globally to prevent evasion. In this context, tariffs are a monetary weapon, serving the same purpose as high interest rates by depriving the world of dollars. The second step is to prevent capital from flowing into China. An interest rate cut will devalue the dollar and push money out of the US last year. When the Fed briefly signaled a pivot, US dollars flooded into Chinese stocks. To prevent a repeat, the US is now allegedly pressuring Japan to raise its interest rates, hoping to divert capital to Japan instead of China. In 1972, a US visit opened China to Western investment. Now a recent visit may be aimed at pressuring China to open its markets again, as the surge in Chinese stocks suggests markets are anticipating this. Two scenarios for a rate cut. The critical question is not if the Fed will cut rates, but how. 1. The rapid cut scenario. A swift cut to near zero would likely cause a collapse in dollar-denominated assets by wiping out the carry trade, where investors borrow cheaply in Japan to invest in high-yielding US assets. But this very chaos would allow the Fed to print money at near zero cost, backstopping US debt and enabling American capitalists to buy up stocks at bargain prices. 2. The slow cut scenario. A gradual reduction would avoid a market crash, but it would fail to solve the underlying problem of US Treasury bonds being unattractive to buyers. A slow cut would mean US bonds remain unsold, and the dollar continues its decline. Notice that in both scenarios, the US dollar is poised to fall. This suggests that safe haven assets like gold, silver, and the Japanese yen are likely entering another bull market. With a rate cut drawing closer, if you want to learn my latest strategies, I invite you to join our free investment training masterclass via the first link in the description. It's worth noting that Warren Buffett has recently started buying stocks. Does this mean now is the perfect time to enter? I'll cover that in the upcoming episodes. If you don't want to miss out, please subscribe, turn on the bell, and share this video. Thank you for watching. My goal is that you found at least 1 or 2 key insights to help you navigate the complex times ahead. I wish you the best on your journey to financial freedom, and I'll see you in the next video.